미국 증시가 8월 초에 급락을 딛고 다시 강세장을 연출하고 있습니다. 페드가 9월 금리 인하 시그널을 확실하게 보내면서 월스트리트에선 소프트 랜딩에 대한 기대와 함께 S&P 500이 올 연말 6,000선까지 오를 것이란 전망도 심심치 않게 내놓고 있습니다. 스티펠의 수석주식전략가 배니스터는 다릅니다. 그는 올 10월까지 S&P 500이 5,000선까지 밀릴 수 있다고 내다보고 있는데요. 배니스터는 이달 초 벌어진 대규모 증시 조정을 지난 6월부터 미리 경고한 것으로도 유명한 월스트리트의 베테랑 전문가입니다. 배니스터를 직접 만나 이야기 들어봤습니다. So about your forecast, do you still view S&P 500 going through a correction to 5,000 by October?
Yeah, we've been on that view. There's a probable correction due to a weakening economy and possibly even a little year-end finale closer to 3% on core PCE. The Fed's target for the full year is 2.8, so it's not grossly excessive, but it's above consensus and above the Fed's view. But the bigger issue is the economy. Fed has gone pretty far on the tightening, pretty long, and usually when you get a weaker economy, as this shows, if we're correct that GDP dips down to a little less than 1.5% by year end, year-to-year change of the S&P 500 versus real GDP indicates a lower year-to-year change. The implied price level would be somewhere in the low 5,000s with a dip through October.
What do you project will happen after October then?
Well, it depends on whether they were tight too long and actually trigger a recession. It's unusual for unemployment to rise like it has, both permanent and U3, without having a prolonged increase. Now, we're aware that labor supply has been strong, and that is an unusual feature of the economy. If you look at the growth of payrolls, which we've already made an adjustment for the 818,000 reduction that BLS gave, the growth of payrolls is a little over 1.5 on a year-over-year basis. Now, the economy weighted purchasing manager index says that it will be closer to 0.5 soon, maybe between 0.5 and 1. You were pretty much going into a recession in the past. It's going to be real hard to avoid.
There are a lot of projections. Some say 20%, some say 35% about the probability of recession. How big a risk do you see of the current economic slowdown deteriorating into a recession?
I'd say it's closer to 40% by year end. We could already be in one. We don't know. It's an unusual cycle. When you think about what a recession is, it's sort of a combined weakness of income, production, sales, fixed investment, and employment. And real incomes have been fairly weak after inflation. Real retail sales was down and now it's up a little bit. Real personal consumption expenditures are okay. Industrial production is unusually weak and has remained so. And I think it should give people pause. Now, it's not a perfect relationship, but take a look at this chart. This starts in 1952, so it's a long time ago. And you can see that all of labor demand, all job openings, and all payrolls, so all the people employed and all the openings, the growth rate of that, and the ISM PMI index, it would indicate weakness is occurring or likely to occur. The ISM just can't seem to get any lift. And so, we're fairly negative on that. So I would say the odds are high.
But some say that because the U.S. economy is much more reliant on service industry, they say that the manufacturing PMI is maybe, of course, is weakening, but it doesn't have much impact. And some say that the layoff isn't going up. So it's not much of a warning signal. How do you think about that?
Well, there are a million ways to look at labor. Certainly the insured unemployment rate has not been stronger. It's not been going up. But permanent unemployment, which is not on temporary layoff, has been going up for over a year. It's never had in 50 years, it's never gone up this much without a recession. We also see that if you take the ratio of all job openings to all unemployed workers, unemployed people, It's still above 1. So you're in a structurally tight labor market, but it is going down like it always does into a recession. So we're saying that it's going to be a weaker labor market that could tip over into a recession, but our forecast for GDP, 1.3, by the fourth quarter. And if it's in that range, it's going to be hard to avoid a sharper drop in employment, which Powell's aware of, but the Fed is not able, with a long and variable lag, to easily manage this process. We also know that if you look at what's called core GDP, we call it that, it's just simply real final sales to private domestic purchasers. It excludes the vagaries of inventory, net exports, and government. So it's just private sector GDP. And that was running at close to 3 year over year. This is year over year. And it's going to probably decelerate to, like I said, around the 1.5 range, based on the economy weighted PMI and some other indicators. It'll feel like, did the Fed make a mistake? Sometime around September, October. And when that occurs, markets could react somewhat negatively, since most of this market has been led by more cyclical companies.
How about last week at Jackson Hole, the Chair Powell, he said he was pretty much dovish. Given that stance, if he maybe lower, maybe 50 BP, I don't know, if he cuts, then could the stock market maybe avoid a decline or the recession? How do you think about that?
Well, we're doing a note right now on the yield curve and what it's saying. But the history of what we're in, which is called a bull steepener, that's where the short end goes down more than the long end. That is not good. It's usually a recession within a fairly reasonable time frame, in real or nominal terms. So we're thinking that the Fed can cut, but Fed cuts have historically been bearish because they're cutting because they have to. So the Fed is not likely to do 50, but I think the consensus is 75 to 100 by year end, and that certainly is likely. We look at modified Taylor rules and come up with 4.5. Some people come up with lower, but we feel like they'll go to about 4%, which is 5 cuts, and possibly even pause for a few months sometime in the first half of 25 if the economy has not rolled over. They will have done enough at that point to take a look around. It doesn't have to be a quarter every meeting. It can be a pause. That's a non-consensus view. Everyone out there thinks they're just going to keep going and going and going, a quarter point every meeting until they get to 3.25 next year. I don't think so. I think based on Powell's position and the Fed's position, both politically and historically, I think they pause at about 4.
When do you see the timeline of pausing? You think that's first half of next year?
Yeah.
The reason of pausing is because of inflation?
The model we use, and it's got a good R squared. I mean, it's not perfect, but it's 0.90 since 1965. That the year-to-year PCE, core PCE, and our model, which is based on 65% unit labor cost, 35% unit non-labor costs, it'll bottom here. After a recession, inflation, which is late cycle, always goes down. After a recession, it always goes down. That's normal. And we had a recession, which was a big call we made 2 years ago. We said that the market peaking in December 30th of 2021 and falling 32% in real terms in 10 months, that, the confidence indicators and so forth for consumers all went negative.
What you call the pseudo recession, right?
Yeah. And it was a recession in everything but employment. Even personal consumption expenditures almost got to zero, but when you hand out $5.5 trillion, a quarter of the economy, because of a virus, of course you're not going to have a classical recession. Everybody had money to spend. That money still exists, but it's gone uphill from consumers to businesses because that's what they bought, things from businesses. So liquidity is there. Fed has not really done a great job of sucking the liquidity out of the system yet. And inflation fell after the pseudo recession. And this is the point historically where it actually starts to rise again or bounce. And we're saying to approximately 3.0 in the fourth quarter. So we'll see. I mean, every month's core PCE versus what the Fed needs to hit its target is the black line. They need 18 basis points every month. We think it's going to be closer to the low to mid 20s by the latter part of the year. When you add that core PCE to the slower GDP, it's the economy weighted PMI versus the US real GDP year to year change. When you add the two together, you could see some shocks to the system, one of which is credit spreads.
But the Fed is repeatedly talking about they have more confidence toward the inflation target of 2%, right? And the market is looking at a July core PCE estimate of just 16 basis points. Why is it so different from your view, you think? What could push inflation back up again?
Well, one thing that troubles us a little bit is supercore. This is core services excluding housing. So it's services only, no goods. It's half of all PCE inflation is supercore. And you can see what it is. It's everything from healthcare to financial services and transportation services. These three, pink, blue, red, are very sensitive to financial factors, the strength of the bond and the stock market, which we've had plenty of. These three, or four, are very sensitive to labor. It's a bit of a mix. But if you look at our model, it looks like you're going to have higher healthcare services inflation, higher financial services inflation, higher insurance inflation, and you're going to bottom out at what was historically the peak of labor costs. So labor-sensitive inflation, bottoming out at what was the pre-COVID peaks. So when that all happens, our forecast is that you'll be at 3.5 on half. Now, if you add housing, Cleveland Fed does a new tenant and all tenant index. Housing inflation follows all tenants, not new tenants. And there's too much focus now on the drop in new tenants, which went up during COVID and came down. Well, this was called government distortion. We passed a bill or a regulation, I don't even know how they did it, basically gave emergency rental assistance program $21.5 billion to backstop all the rents in America. If I'm a landlord and I know that my existing tenant has to be in arrears for 3 months for me to collect on a government program, then an existing tenant is worth more to me than the risk of a new tenant. So I'm going to raise the price on new tenants. And that's what happened. New tenants went up and then they came down, starting in 100 in December of 18. So we think 4% housing, 3.5% super core, slightly negative goods, but freight rates are up, transportation. We're coming out in our model with 3% year-to-year PCE in the fourth quarter.
You said that there are still much liquidity in the market. And some say that recession could be avoided due to the stimulative effects of U.S. fiscal expansion. What do you think about the fiscal expansion part?
Well, actually, fiscal is somewhat tight now because it's the change in the deficit. So if the deficit is 5 and the next year it's 4, it's considered to be a 1-point tightening. So we've actually tightened a little bit, and their ability in the government to respond to a recession is somewhat crimped by the fact that interest expense is now a much larger line item in the government's budget. It's actually exceeding the defense spending, if you can believe it. And we're the largest defense spender in the world, so that's pretty sad. I think that they're going to be somewhat constrained, but you have two populists running for office. You know, make no mistake whatsoever, this is an election between two populists. One is what we call a left-wing populist, and one is a right-wing populist. And populism does not believe in fiscal austerity, which is probably one of the reasons that and the seizure of Russia's money is the reason that central banks around the world are accumulating gold. And also some currency manipulation, you know, in China. You might be better off in gold than real estate, we'll see. But, you know, if I look at this, I think that it's not going to be a fiscal story. It's not going to be a really liquidity story, a fairly pricey valuation. The market is not cheap. And that, that's a complicated subject, but valuation is almost a science. This is the price to earnings ratio on trailing 12-month operating earnings. Every month is shown here. We're at a pretty high valuation. We've been here before, but it usually doesn't end well. And the only problem is that if PE ratio comes down, it fights against earnings going up, and the net effect is a lower return. The bottom line is that, we make a good case that price earnings ratio will go from 25 to 18 times. Earnings should double from 2024 to 2034. I mean, that's a common number. It's pretty much in line with what you would expect from nominal GDP plus buybacks. But if I double the earnings and take down the multiple by a little over a third, then after inflation of, let's say, 3% headline CPI, 2.5% headline PCE, we'd be looking at a 3% return, including dividends, for the 10 years ended 2035. So you've been talking to investors who got very used to making 14% a year for 10 years after inflation through 2021. And now they're going to have to get used to making 3 after inflation, which is more in line with the low end. This chart starts in 1825. So the 10-year compound growth rate after inflation with dividend reinvested is highly cyclical around this 6-7 line, which is called the Siegel's constant. Jeremy Siegel at Wharton showed that over, a lifetime, you should make 6.7 compounded. But as you can see, the variability around that line is enormous, lasting 1 or 2 generations. So my generation was lucky. We got this, but I think your generation gets this.
What's confounding me is, will the market really go according to the history? Of course, it's a short band of time. Until now, it doesn't seem to work that way. Maybe it's because of what you call the AI hype or the unusually high valuation. I don't know, but everything points to correction, but it doesn't get corrected.
Looking also at another way of doing valuation, it's using what's called an earnings yield minus a 10-year real yield. In 1901 and in 1929 before the crash, and then 67 in the go-go market, and 99 in the tech bubble, we've been at a very low premium to the risk-free yield. But right now, on the basis of a 10-year average inflation-adjusted earnings yield, you're at 1.5. You're getting close to the median of all these lows when you had things like automobiles, radio, chemicals, semiconductors, computers, the internet, telecommunications, fiber optic. I don't think generative AI is bigger than the internet. I don't think it's bigger than telecommunication, my ability to call people and communicate. I don't think it's bigger than the silicon wafer. I don't think it's bigger than the advent of computers, or even bigger than automotive transportation, truck transportation, and radio wave communication. I just don't. You know that everyone was extraordinarily bulled up on technology at each of these bottoms, every single time. And they overpaid. One of the problems of seeing 2 generations like I have is that, I remember the late 90s tech bubble and the insanity and the day traders and the roaring kitties at that time. It's the same kind of thing going around now. It could go on a little longer, but I'm not sure I'm going to stick around for it, to be honest with you. I just can't believe how crazy things could get.
So everybody says it's different this time, but it's not different. And you think the bubble burst is going to happen. If you can give like a timeline, when do you think that'll be coming?
Not that it's so much of a bubble, and it's starting to broaden out just a little bit, but what we are seeing is this unbridled optimism is going to probably lead to a snapback rally for what's called defensive value. So if you look at defensive value, what is that? That would be things that benefit from inflation coming in slightly hotter than expected and the economy coming in a little weaker than expected. And we're not saying a lot, just a little bit of both. Really a little bit more economic weakness than inflation. And So that benefits things like household products, utilities, healthcare equipment, healthcare services, food, beverage, tobacco, household products, dividend yield strategies, low vol strategies, biotech, pharmaceutical, life sciences. That's where we would want to be. And there are a lot of reasons why in the note, but relative to the S&P, they're coming off that post-pseudo recession cyclical optimism. And then after a while, people get overbought on the stock market and you want to go back into defensive. So we think the defensive and the value side of defensive will get a rally here. And, if they do work, and if a recession is a risk, then 70% of all their performance occurs before the National Bureau of Economic Research declares a recession. They're 6 months late. So 70% of my relative performance in defensive value will already be done by the time you find out you're definitely in a recession.
So we should go in now?
Go in now. I think you're turning up now. I mean, you can just see it starting to turn up here. We're probably 6 months away from a recession based on the average. And then you would hit the recession, but not very few people, other than maybe the stock market, will have known it would be falling. But people won't know for sure. It'll be a lot of speculation, and then they'll declare it right here after it's already pretty obvious. Point being is that it's late in the game to be a bull. It's overvalued. There's a lot of euphoria. There's economic risk. There's this unbridled optimism that Jay Powell is somehow the Wizard of Oz and that he's managed to pull off the elusive soft landing, the first one since Alan Greenspan in the 90s.
Till November, we have the political risks, uncertainties going on because of the presidential election. What kind of effect do you foresee?
I think everything that we see in the world today on a geopolitical basis is going to have to be resolved by first quarter of 2026. So you have a lot of people in stasis just waiting on whatever the outcome is. And so Russia and Ukraine seized more Russian territory, and then they seized some Russian troops. They're just trying to get bargaining chips for an eventual peace talk. Iranians have been withholding their full force because they're waiting to see who wins and what to do. I think long-term, China is more on the financial than the territorial aspirations right now, but they're not doing much with currency, and they have to decide what to do with currency. If Trump comes in and does high tariffs, they might have to let the yuan slide. So a lot of things will happen by Q1 of 26 that are disruptive, and yet nobody seems to care, and that's only 6 months away. Well, Jay Powell leaves office. He will leave office almost certainly in, I think it's going to be around May of 26, April, May. He'll be replaced by somebody. If Trump wins, he'll replace him. If Biden wins, he'll replace him. My guess on both of them is Kevin Hassett if Trump wins, and Lael Brainerd if Harris wins. I'm not sure, but I think that's what will happen. So he knows he's on his way out, and I think he wants to secure not just the Fed's independence, but he doesn't want to go down in history as the guy that screwed up on the inflation question. So that's another reason for a pause in Q1, sometime in Q1, late Q1 of 25. Just pause at 4 for a little while, take some time, see how the data. And if we're already in a recession and they know it, I mean, they're going to know it before it's declared, then they'll cut all the way down to the low 2s, but don't tell me that's bullish. You're going into recession. You're looking at minus 19 is the average delta for earnings in a recession. That's the average. So you take a fifth off the current S&P number, you're talking about taking $50 out of the consensus. It's not going to be bullish initially, at least initially.
You said that until the 1Q of next year, there are many geopolitical risks unfolding. And you said that could lead to commodities into a new super cycle. So do you still hold that view? And maybe about the gold hitting a new all-time high recently. Do you believe it's wise to getting into gold right now?
Copper to gold, gold to oil, silver to gold. I mean, they all have different meanings, right? So you take ratios, and that's more of a shorter term call, I think. Longer term, gold will go up with other commodities. It always does. There's a high R squared in big cycles. The big cycles of commodities since the year 1795, shortly after the American Revolution, we know that they go up and down. We just came off of the lowest 10-year compound growth rate for commodities in 2 centuries in April of 2020, when crude oil went negative. WTI went negative. Copper was dirt cheap, and you know what happened. So we just came up off that, and we're bouncing around zero. But there's a whole section here where we talk about in great detail what's going to happen next. But, you know, Russia, Ukraine, Iran, Israel, China, Taiwan, North Korea, greenflation, lack of capex in oil and gas in the US. We're going to see some, I think, maybe 5 compound growth rate over the next decade. Now, 5 is not dramatic. It's kind of very early 19th century-ish. It's quite simple. You want to know where commodities are going? Tell me where the supply of money is going. And why do you create a lot of money? To fight wars, to pay for social programs, to accommodate new countries like China. I think we're going to have some conflicts and a hell of a lot of social spending. Both candidates want to expand social spending dramatically. Both of them.
Trump too?
Oh yeah, he wants to take care of Social Security, Medicare, the vets, you know, all the people who voted for him. And Kamala Harris wants to just hand out money to the middle and lower quintiles. Just hand it out willy-nilly, you know. Oh, you've got 5 kids, here's $30,000 a year. So yeah, and it's not a good move. If that happens in the next 10 years, then yeah, commodities are going up. And if they go up, we know what that means. It's a weaker dollar and more reflation. I mean, there are mechanisms. Japanese yen is 45% undervalued right now on purchasing power parity. We know for a fact that China has $2 trillion of corporate cash overseas, that if their currency starts strengthening, they'll push that thing higher. There is a huge amount of imbalances in the world on currency. Huge. Euro is repressed because despite their central bank raising rates, their growth is anemic. But euro probably has some upside. The yen has a lot of upside. I think the yuan has upside.
There were so many interpretations about the recent market crash that it's attributable to the unwinding of yen carry trades. How much do you think that's true?
That was most of it. It was most of it. I think.
So it's
Yeah.
coming more? More is coming?
No, I think the carries have largely unwound. The ultimate carry, though, is the fact that the Japanese are huge foreign investors. They have $6,000 billion overseas of invested money. They are like the new Dutch of the 1500s. The Japanese are very rich. They have by far the largest foreign assets net as a per capita basis of any country that's of that size, any big country. So if that money ever senses that the yields in Japan are going up again, then that money's, some of it's coming home. And that plus, you know, as I mentioned, the Chinese corporates with their overseas hoard of cash, you know, there's too many ingredients for a weaker dollar. And by the way, when the dollar weakens, historically, value beats growth. And when commodities strengthen, historically, what we see is that value beats growth. So large cap value relative to large cap growth, which just bounced off the same level as 1939, which if you know your history is September is when World War II began, then I would rather own a value index. I mean, my second largest holding is a value index personally. And I like, you know, value, large cap value for the next 10 years should be an outperformer in almost all the scenarios that I've run. I won't be as interested in growth because growth needs low inflation. Growth is everything from Amazon to Microsoft to Tesla to Apple to Alphabet, Meta, NVIDIA. These are all growth companies and they're all disinflation trades. Wall Street only cares about 2 statistics, truthfully, inflation and the cost of money, rates. If you know those 2, that's all you need to know. What's money going to cost me and what's the inflation rate?
Forward 12 month, do you see like the dollar index moving to below 100?
Yeah, there's the broad dollar, which would include the Chinese yuan. And then there's DXY, which does not, but you know, it's highly correlated. So DXY would probably move down in the next 12 months with Fed rate cuts and non-US already been through a recession, US just entering one, I'd say it probably drops to about 90 from 103, 104. A weaker dollar tends to be reflationary, and that's one of the mechanisms to get out of a recession. We probably will blow out the fiscal. So what you will have is rate cuts without a long end response. In other words, the long end would respond, but not as much as it normally would. And that would be what you call a bull steepener, which is to say bullish for the short-term rate going down, the longer-term yield going down a little, but not as much. Those are typically not the best environment for stocks. If you go back and look, bull steepeners are terrible for equity performance.
Thank you so much for your time. It was a really precious insight. Thank you.
Thank you. Enjoyed seeing you.